The screens don't flicker with drama when history shifts, at least not at first. There's no alarm bell, no official announcement that the rules have changed. Instead, there's a number, quiet, clinical, easy to ignore if you don't know what it represents. On a Tuesday in January 2026, that number sits just under 50. It takes just under 50 ounces of silver to purchase 1 ounce of gold. To most people, that's a statistic. To a small group of observers who study monetary patterns, it's something else entirely, a signal that has echoed across centuries, often before moments of upheaval. This relationship between gold and silver is not a modern invention. For generations, it has functioned as a kind of financial compass, guiding those who look beyond currencies and into the deeper structure of value. Long before digital markets and high-frequency trading, societies anchored their economies to these two metals. For over 200 years, the ratio between them was not left to speculation. It was fixed, enforced, and widely accepted. 15 ounces of silver were equal to 1 ounce of gold. This wasn't guesswork. It was considered equilibrium, a balance shaped by geology, trade, and human agreement. Then the world changed. As financial systems evolved and paper currencies took hold, that fixed relationship began to drift. The early 20th century marked a turning point. Monetary systems detached from physical backing, and the ratio between gold and silver was set free to move with market forces. Since then, it has behaved less like a constant and more like a barometer, rising and falling in response to confidence, fear, and systemic stress. What makes the present moment unusual is not just the number itself, but where it sits in historical context. A ratio hovering around 50 is not unprecedented, but it is significant. It suggests a narrowing gap between the two metals. And historically, such compression has often coincided with periods when financial systems were under strain. The ratio doesn't predict the future with certainty, but it has a habit of reflecting underlying tensions before they become obvious. There's a tendency to focus on price. Silver at $95, gold approaching $5,000. These numbers feel large, even shocking, especially when compared to past decades. But price alone can be misleading. It is influenced by currency, and currencies themselves are not fixed points. They inflate, deflate, and lose purchasing power over time. When you measure one asset against another instead of against a currency, you strip away that distortion. You begin to see relative value more clearly. This is where the ratio becomes powerful. It's not about whether silver is expensive in dollars. It's about whether silver is expensive relative to gold. And right now, by historical standards, it is not. Throughout modern history, extremes in the ratio have tended to correct themselves. When the ratio becomes very high, meaning silver is cheap relative to gold, it has often been followed by periods where silver outperforms. When the ratio becomes very low, the opposite tends to happen. These shifts are not instantaneous and they are not guaranteed, but the pattern has repeated enough times to attract serious attention. Consider past moments of stress. During times of war, economic collapse, or monetary instability, the ratio has moved dramatically. Sometimes it widens, reflecting a rush into gold as the ultimate store of value. Other times it compresses, as demand for silver increases due to its accessibility and dual role as both a monetary and industrial metal. Each movement tells a story about how people are responding to uncertainty. What complicates the current situation is that multiple forces are converging at once. On one side, there's growing concern about debt levels, currency stability, and long-term economic sustainability. On the other, there is increasing industrial demand for silver, driven by technologies that rely on its unique properties. This combination creates a dynamic that is different from many past cycles. Gold has traditionally been the asset of institutions, central banks, large funds, and entities seeking stability. Its role is preservation. Silver, by contrast, occupies a more complex position. It is both a store of value and a critical component in manufacturing. It is used, consumed, and often not recovered. This means that while gold accumulates over time, silver is gradually depleted in certain forms. That distinction matters. When demand for silver rises, the supply response is not always immediate. Mining output cannot be increased overnight, and much of the silver used in industrial applications is dispersed in ways that make recycling difficult. This creates the potential for tighter supply conditions, especially if investment demand increases simultaneously. At the same time, accessibility plays a role. Gold, at several $1,000s per ounce, is not easily acquired by everyone. Silver, even at elevated prices, remains more attainable. This difference can influence where new capital flows, particularly during periods of heightened interest in tangible assets. The ratio, in this context, becomes more than just a number. It becomes a reflection of shifting preferences, constraints, and expectations. When it moves, it captures the combined effect of all these forces. Still, it's important to approach it with caution. The ratio does not move in straight lines. It can fluctuate, reverse, and remain at levels that seem illogical for extended periods. Markets are influenced by sentiment as much as by fundamentals, and sentiment can change quickly. What appears to be a clear trend can stall or even reverse under the right conditions. There are also different interpretations of what the ratio should be. Some point to the historical 15-to-1 standard as a benchmark. Others argue that modern conditions, industrial use, mining practices, and financial markets justify a different equilibrium. There is no universal agreement, and that uncertainty is part of what makes the ratio both fascinating and challenging. For those who pay attention to it, the ratio can serve as a guide rather than a rule. It can inform decisions about when one metal might offer more relative value than the other. It can provide context for price movements that might otherwise seem disconnected. But it is not a crystal ball. One of the more strategic ways it has been used is in switching between metals. Instead of thinking in terms of buying or selling based on currency prices, some investors focus on accumulating ounces. When the ratio is high, they may favor silver with the idea that it has more room to appreciate relative to gold. When the ratio compresses, they may shift back into gold, effectively increasing their holdings without additional capital. This approach requires patience and discipline, as well as an acceptance of uncertainty. It also requires a long-term perspective. The ratio can remain elevated or compressed for years. Short-term movements can be misleading, and attempts to time them precisely often lead to frustration. The broader trend, rather than the exact turning point, tends to be more relevant. Another factor to consider is the broader economic environment. In scenarios where deflationary pressures dominate, where liquidity dries up and assets are sold off, gold has often outperformed silver. In more inflationary or expansionary environments, silver has sometimes taken the lead. These dynamics can influence the direction of the ratio, adding another layer of complexity. The current environment does not fit neatly into a single category. It contains elements of both inflationary and deflationary risk. Debt levels are high, monetary policies are evolving, and geopolitical tensions are present. This mix creates uncertainty, and uncertainty tends to drive interest in tangible assets. What happens next is not predetermined. The ratio could continue to compress, suggesting a period where silver gains ground relative to gold. It could stabilize, indicating a balance between the two, or it could widen again if conditions shift in favor of gold. Each outcome would reflect a different set of underlying forces. What remains consistent is the role of the ratio as a lens. It offers a way to look beyond headlines and focus on relationships. It simplifies a complex system into a single comparison, allowing for a clearer view of relative value. For those watching it now, the question is not just where it stands, but what it might imply. A ratio near 50 is not extreme by modern standards, but it is notable. It sits at a point where past movements have often accelerated, though not always in the same direction. The key is not to treat it as an absolute signal, but as part of a broader framework. It can complement other indicators, provide context, and help frame decisions. But it should not replace critical thinking or a balanced perspective. In the end, the relationship between gold and silver is a story about value, trust, and adaptation. It reflects how societies choose to measure and store wealth, how they respond to uncertainty, and how they balance tradition with change. The ratio captures that story in numerical form, distilling centuries of history into a single figure. Whether it continues to move, reverses course, or settles into a new range, it will remain a point of reference for those who look beyond the surface. It will continue to reflect the shifting dynamics of markets and the evolving nature of money itself. And while it may not provide all the answers, it asks the right questions, quietly, persistently, and with a depth that becomes clearer the longer you pay attention.